Hello, let's discuss revenue recognition. First, what is revenue? Revenue is the total income generated by the operations of a business. So what is revenue recognition? Revenue recognition is a generally accepted accounting principle that recognizes revenue when it is earned. That is, when a business has fulfilled their duty in providing goods and services to customers. Therefore, revenue is not only recorded in the receipt of cash. Revenue recognition follows the accrual basis of accounting, where accrued revenue is recorded when it is earned, and cash is not always immediately received. Let's compare this to cash basis revenue. This is when revenue is recorded only when cash is received, as the name implies. This is not endorsed by the GAAP as it violates revenue recognition. Let's use Mikey's house building as an example. One day, Mikey built a house for a customer. Now let's assume that the total of the house was $1 million. Prior to building the house, the customer paid a 50% deposit. Then the house was built. The customer, however, still owes $500,000, which is the remaining 50% of the $1 million. So how will Mikey recognize this revenue? First, Mikey will record the amount owed to him as an accounts receivable. Second, Mikey will record the amount of the receivable as revenue. And third, Mikey will record the revenue and apply it to all relevant financial statements. This is what Mikey's general journal should look like. First, Mikey will debit the accounts receivable and credit the sales revenue, both for $500,000 each. The accounts receivable is an asset to the business, therefore it is debited. The 30-day period is the average age of an accounts receivable account. So let's assume that 30 days later, Mikey receives the money from his customer. This is what Mikey's general journal should look like. First, he will debit his cash and credit the accounts receivable. The accounts receivable is credited because the customer no longer owes Mikey money. But what would Mikey do if the customer never paid? Well, recording revenue before receiving a cash receipt is risky. However, business owners can implement measures and methods that reduce this effect that it may have on profits and other accounts on financial statements. This is done by following the qualitative characteristic of prudence, which is anticipating uncertain accounts such as accounts receivable that may be uncollectible. That is, the customer never pays their debts to the business owners. Thank you.